Hey guys, it's a Dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, for today we're going to look at the overall portfolio sitting at $53,180.46. Of course, that's going to fluctuate because the market is open. So we're going to go over the overall portfolio value, the performance based on the metrics, as well as the buying power, the individual stocks and how they're performing, very red day today. The watch list and what price I want to buy Berkshire at. So let's jump right in. So for today, we're down $216, still sitting at above 53,000. For that 1 week mark, we're down $234, right about the same amount as my dividend, but down about 0.5% for the week. That 1 month mark, we're down $262, down about 0.5% still. That 3 month mark, we're still up nearly little over $1,400, looking at a near 2.8% return for the past 3 months. Then year to date, we are up $3,348.51. We have a 6.7% return year to date. Then that 1 year mark, we're up $5,413.43 with an 11% gain. Then all time, we are up $17,843.71 with a 50% gain all time. So guys, if you look at it in the short term, the market is a voting machine. So it's all based on emotion and where people think the stocks are going, the buying and selling of, minute by minute in the market. Long term, your performance is based on the earnings of your companies. And as long as the companies are earning more and generating more cash flow year over year and growing, even if it's a small amount over time, your portfolio will reflect the growth of those companies. So over the course of time, of course, we're going to have some dips. We've got the big dip from COVID. I lost what was that? It says $2,000, but it was more than that. Then we peaked up a little bit, dropped back down, had a huge rise. Then it created again in October of 2022. Look, I was up to 54K, and then it dropped all the way down to 44. So I lost $10,000, but you see I didn't sell out. Now I've held it again. We got up to near 53K. It dropped again in October of this past year, in 2023, down to 44 again, and now we're back up to nearly, a little over 53. I've been at 54,000. So it is, you do see some volatility. It can be unnerving. It is a little frightening sometimes to see your portfolio, go up and down by 10 grand. But as long as you hold the stocks and they grow over time, you buy quality, you're going to gain over the long term. So right now we have a buying power of $222.57. That's going to be going up this month because I get paid by Altria, Realty Income, and CocaCola, I believe, already paid us for this month, but it still adds to my dividend income. Jumping in, today we are at $52.96 for Realty Income, 170 shares, $9,000 worth of market value. Average cost is $65.03. 17% of the portfolios in Realty Income. Today we're down $22. Total, we're down a little over almost $2,100 with an 18.5% loss. We have a $44 dividend coming in on the 15th. So in about 8 days, we'll have a $44 jump up in our free cash. So love Realty Income. I want to buy it at these prices, but I just don't want to add any more to this position. So that's one of the hard things about being a dividend investor is Realty Income right now is sitting at I think an 8% yield, something like that. Well, it's 6% yield. And I love the company. I loved it at 65, so I love it here, but I just want to buy something that has a little bit higher dividend growth rate. So Realty Income only bumps up the dividend 2% a year. And given that I think interest rates are going to take a while before they go back down, I think REITs are going to stay at this depressed level for a while. So I think this is a not a short-term opportunity. I think I have a little bit longer to take advantage. So that's why I'm going to look at a couple other options. And it's already 9K, 17, nearly 20% of the portfolio. So nearly a fourth of my money is in Realty Income. And so I want to spread the wealth a little bit. I want to put a little bit more capital into these smaller positions so I can build them up. So Realty Income isn't as isn't as big of a position, so I'm not as vulnerable to interest rate changes. But I do love the business model. I love that I get rent every single month without the headache of getting calls at 2 a.m. about a toilet, leaky faucet, AC going out, et cetera, whatever comes up. I don't have that BS when it comes to Realty Income. So I do love the business. I enjoy the business model. I really do appreciate the monthly cash flows. It just doesn't grow as much as some other opportunities that I've been seeing currently. Then we've got Altria at a near $46 per share, 320 shares, $14,000 worth of market value. Average cost is $47.27 with 28% of the portfolio in Altria. Today we're down $35. Total we're down a little over 400 with about a 3% loss here on this position. Dividend income though is amazing. Altria is paying us a $313 dividend. And guys, this is a dividend king. It's grown its dividends for over 50 years. Management wants it right around where it's at with a payout ratio. They have great brand recognition and great branding power when it comes to their Marlboro brand, and they have the power to price increase on that, and sales don't dip. So that's one of the things that I do like about this. It's the Coca-Cola of cigarettes. Do I love it? No, I smoked for a few years, so that's why I put so much capital in this. I wanted to get some money into it to get some money out of it. So I'm going to use the dividends to buy something else. I'm not going to reinvest back into the company, even though I have a small cost on average opportunity here. This money is going to go towards something like Apple, like AbbVie, like Visa, like Google. Even Realty at some point might get some of these dividends, but I will not be reinvesting it simply because I feel like out of all of the businesses that I own, Altria is the lowest quality, and I want to really focus on higher growth, higher dividend growth as well, but higher earnings growth as well. Not a declining business. I want to put more money into, honestly, Apple, Visa, and Google before I put it back into Altria. Now, if those stocks jump up, like say Apple has been, I would consider Altria for the free cash that I have currently. But as of right now, I want to, like I said, with Realty Income, I want to spread the wealth. I want to change my overall portfolio construction, not by selling, because I do love the dividend income I'm getting from these positions. I just want to reallocate the dividends and free cash that I put into the portfolio into higher growth opportunities. Next, we got Coca-Cola. Now, guys, this is one of those that I want to buy and own for the rest of my life. I love Coca-Cola. I had like 60 shares a couple years ago. I went back through and did the math. I've owned Pepsi as well. I had 20 Pepsi shares, and I think it was nearly 100 shares of Coca-Cola. So I was dumb. I'm going to just own the stock, buy it when it dips. It's a high quality company. It's my favorite company. Love Coca-Cola. I love Sprite. I drink it. It's been like 100 degrees here in Iowa every single day. I've been drinking Sprite, Coca-Cola. I even been drinking Smart Water. So I like to stay within the Coca-Cola family. I really do love the brands, and I love Coca-Cola. I have some in my fridge. So this is just one of like this is my fanboy pick. Okay, this and Apple are my fanboy picks, and I think that's okay. So I have 15 shares, right around $950 of market value. Average cost is $60.54. Right around 2% of the portfolio is in Coca-Cola. Today we're down $9. Total we're up nearly 40 with a 4.3% return here, nearly 4.5% return. So I'm up a little bit. This is still in my buying area. I would probably cut it off around $67 per share. So I still have a little bit of give when it comes to the fluctuation of the stock and where I want to add more capital. But guys, this is going to be one of the big three positions. I wanted to go Apple, Visa, Coca-Cola. I'm talking like a decade from now. That's how I want the portfolio to be set up. Now, is it going to go that way? No. We have companies like Altria, like Realty Income that are down right now. That as of right now, that's where the smart place to put my capital is. Not in Apple, not in AbbVie, because they're up so high. So the overall build of the portfolio might be a little bit different, but that's my goal. I want it to be Apple in first, then Visa, then Coke. Next, we've got Apple, which doesn't want to fall. We've only got one share, so market value, of course, is what the price is as it fluctuates. So it's at $226 right now. Average cost is $132. 0.5% of the portfolio is in Apple. Today we're down 4 cents. Total we're up 93 bucks with a 70% return. Guys, I wouldn't mind this being like 30% of my portfolio. I love Apple. The problem is I owned it in 2018. I only owned 2 shares. That was before all the stock splits. And so I kind of wanted to wait until the stock splits were done. I bought some early last year, and I just haven't been able to buy anymore because the damn thing keeps going up. So I might just bite the bullet, buy it at an inflated price, and then wait for it to crash and have cash on the side to really take advantage of a pullback. But as of right now, guys, I'm not going to be purchasing it with free cash just because I think I have another opportunity that's better than Apple as of right now at the current price. But it will be the biggest position in my portfolio given time. Next, we've got AbbVie at 166. We have 95 shares, $15,800 worth of market value. Average cost is about 95 bucks per share. 30% of the portfolio is in AbbVie. Today we're down 87 bucks. Total we're up 6,700. We have an accumulated 74% return here on AbbVie. Guys, this was an arbitrage deal. It's a merger and acquisitions deal. Sorry, not arbitrage, just merger. There's a merger deal. Merger and acquisitions. So they bought another company. I thought that I thought AbbVie was undervalued for as well as it was doing. And then I thought Allergen, bringing in what they owned, being Botox and a couple of those big name drugs. But Botox is really the big one that they had out when they acquired them. I looked at the cash flows from Botox alone, and I thought that being added to AbbVie, say it was at $100 per share. I think it was around 88 originally. So if AbbVie was worth like 90, just based on the market, I figured with the added assets, it would be like 150 150 to 160, and here we are at 166 per share. So I did a pretty good job, guesstimating kind of where the stock was going to be once the merger was done, and they don't always happen like that. I mean, AT&T had the Warner Brothers acquisition, and they thought that people were going to watch it on their phones, and somehow that was going to tie into their cell phone sales and their cellular offerings, and it didn't. They didn't correlate at all. So they spun it out. So not every acquisition is profitable. And sometimes companies buy other companies just because they don't want the competition, and then they just sell off those assets or they let it die within the company. So it's not always as clear cut as the AbbVie acquisition. But I am glad that I took advantage. I am getting like 165 bucks, I think. It should show down here. 150, sorry. Yeah, $150 worth of free cash every single month. So I'm happy with the position. I'm not going to add to it at these prices, obviously. It's way inflated. It's where I thought fair value was when the acquisition happened, but it took them like 3 years to figure out, what I had estimated. So I made a prediction and I was right overall. That's great. But hopefully it drops because I want to own more of AbbVie, but I won't buy it at these prices. Next, of course, we got Visa. Now, this is one of my personal favorites, one of my top 3 foundational stocks for the portfolio. It's at $267.32. So it is actually below my average cost as of right now. So I got 1 share. Of course, it reflects the market value because I only have 1 share at $267. Today, our average cost is sitting at $268.29, so we are down, which is great. Down 304 today. The portfolio's percentage for Visa is 0.5%, so right about the same position as Apple, to be honest, in the portfolio, which definitely should change. Down about $1. So a small buying opportunity for Visa, but any dip on Visa is a buy. Then we've got Google at 191. Guys, I'm up big on this as well. 3 shares, 573 of market value. Average cost is 165. So up nearly $30 per share. Here, we have a 1% of the portfolio in Google. I do want this to be in the top 5. Down 285 today, up 76 bucks with a 15% return. So guys, I want Google to fill that 4th or 5th spot. I want that or Berkshire to be 4 or 5. So this will be one of the bigger names in the portfolio. Hopefully we see some more dips because as of right now, it's way too high. I wish this would drop a little bit like Visa. And then we got T. Rowe Price at $114.25, 100 shares, $11,000 of market value. Average cost is $109.73. 21% of the portfolio is in T. Rowe Price. So this and AbbVie are near the same amount of of consistency in the portfolio. That will change over time. Down about $50 today. Total, we're up 450 with a 4.5% return. And then, guys, for Berkshire, I've talked about it in like every video, but I want the insurance arm is the really big thing. And See's Candy, to be honest with you, if See's Candy was a standalone business, I would be purchasing it, as well as there's a couple of the private companies like Aldi or State Farm that I would like to own, or just be able to analyze and possibly put my money in. But I love Berkshire, guys. I will have enough to purchase a share with dividends after that Altria payment. But I think I'm going to be purchasing more Visa just because it does have a dividend. And I love the business. But I will own Berkshire before the end of the year. So guys, with that being said, thank you so much for watching. Remember to hit subscribe on my channel, That Dividend Guy. I do want to apologize. I know I was kind of scarce with videos there for a little bit. We did have a family emergency, so I was busy tied up with family stuff. So I will be posting Monday through Friday this week, and I'm super excited. So thank you so much for watching. Remember to hit that subscribe button on my channel, That Dividend Guy. If you enjoy the content, enjoy the journey, enjoy me posting videos and sharing, being very transparent with my overall net worth. I just love making the videos. And guys, remember, I started at zero. I didn't inherit anything. This is literally me working like for $9 an hour, $12 an hour. I make $15 an hour right now. So it's like I work minimum wage and I made this happen. So if I can do it, you can too. That's really my goal, is to inspire people to start investing, because everybody that was around me told me I was dumb, that I was going to lose all my money, had all these doom and gloom stories about how the stock market only goes down and you're going to lose everything. It does go down. But if you own quality and you buy that quality at a lower price and let it grow, overall, it's such a beautiful thing. I'm so glad that I jumped into it, and I'm glad I started investing and showing you guys the journey as well. So thank you guys so much for watching, and I'll see you guys tomorrow with another Robinhood portfolio update. Take care, guys.